Welcome back to Factful Finance, where we dive deep into the world of money, economics, and policy. If you've been following the market lately, you've probably noticed some unsettling shifts. So here's a question for you. What if a single policy decision could wipe out trillions of dollars in value? That's exactly what we're seeing with President Trump's trade tariffs. And today, we're going to break down how this is shaking up not just the stock market, but the broader economy. Let's dive in. Since February 19th, the S&P 500 has plunged over 8% from its all-time high. And in just a few weeks, $4 trillion in market value has been erased. How? Well, it all starts with President Trump's tariffs. These moves, targeting major trading partners like China, Mexico, and Canada, have investors in a panic. Let's unpack what's going on. Now, while many were initially optimistic about Trump's pro-growth agenda, such as tax cuts and deregulation, the uncertainty around tariffs has shifted the mood. Companies and investors hate uncertainty. It stirs fear, slows investments, and as we're seeing, pushes markets into corrections. Take Delta Airlines as an example. They recently slashed their profit forecast due to growing economic uncertainty. And it's not just Delta. Tesla lost $125 billion in value in a single day. Imagine waking up and seeing your portfolio take a hit that big. It's not just a bad day. It's a massive loss of confidence in the future. So why are tariffs causing this? The tariffs, meant to boost domestic industries, are instead disrupting global supply chains, raising costs for businesses, and causing chaos in industries like tech and manufacturing. Look at the NASDAQ. It's down 10% from its December high, and technology stocks are taking the hardest hits. Apple, Nvidia, and Tesla, all down 5% or more. These aren't small players. They're titans of the market, and their struggle signals a larger trend of investor unease. But here's where it gets even more interesting. While the tech sector is suffering, some defensive sectors like utilities and government debt are holding up better. It's a classic example of flight to safety. Investors are moving their money out of riskier assets like stocks and into government bonds and utility stocks, which are seen as more stable during times of economic turmoil. And here's the thing. Valuations are still high. The S&P 500's price-to-earnings ratio is over 21, well above its historical average of 15.8. That means stocks are priced for perfection, and any hint of uncertainty, like we're seeing now with tariffs and trade wars, can send markets into a tailspin. Take this example. Imagine an investor named Liam who's been riding the bull market, buying up stocks left and right. But now, with tariffs weighing on the economy, he's wondering if he's too exposed. Should he pull back? Or is this just a temporary dip? Here's the answer. Diversification. By spreading investments across various sectors, like utilities or even foreign markets less impacted by U.S. trade policies, Liam can weather these storms a lot better. Now, let's look at the broader economic picture. According to the Federal Reserve, the wealth gap is widening. The bottom 50% of Americans own just 1% of corporate equities, while the top 10% own 87%. This means that market movements like these disproportionately impact the wealthy, but they also affect the economy at large. Economic uncertainty can lead to lower consumer spending, reduced business investment, and ultimately, slower economic growth. So, if you're in that 50% with minimal stock ownership, it's crucial to think about diversifying your assets, whether that's with retirement savings, home equity, or more stable investments. So what's next? Well, it's hard to predict, but one thing's clear. Market volatility is here to stay. Investors are already scaling back their exposure to stocks, hedging their bets with safer assets. And while this might feel like a setback, it's also an opportunity. If you've been waiting for a market correction to rebalance your portfolio, now might be the time. Which brings us to the big question. How do you protect your wealth in a time of policy-induced uncertainty? Well, diversification remains key, but beyond that, it's crucial to stay informed. If you haven't yet, now is a great time to meet with a financial advisor who can help you navigate these choppy waters. Always remember, this content is for educational purposes only. Consult with a certified financial professional to create a strategy tailored to your situation. So, what do you think about the impact of Trump's tariffs on the market? Are you worried, or is this just a temporary dip? Drop your thoughts in the comments. I respond to as many as I can. And if you're looking for more insights on how to protect and grow your wealth, don't forget to hit that like button and subscribe. We've got a lot more content coming your way. If this video helped you understand the link between economic policy and market movements, you'll want to check out the next one. Click here to keep your financial knowledge growing. Remember, uncertainty is a constant in the markets, but with the right strategies, you can make it work for you. See you in the next one.